This is an incoming transmission from the Jersey Shore.
This is Financial Insanity with Scott McLean, powered by McLean Advisory Group. Today you'll hear some of the most important financial information and wealth-building techniques available anywhere.
Let's get this party started, huh?
Do you have a question for Scott and the team?
Am I on the air?
609-488-4646. That's 609-488-4646.
We'll get that information to them by radio.
Now, Financial Insanity with Scott McLean.
Could our country be facing a retirement savings crisis? This is Financial Insanity. I'm Alex Dingman, alongside, as always, Scott McLean, McLean Advisory Group. And we're going to be talking about this new study that seems to paint a fairly bleak picture of retirement savings in America, but it's never all doom and gloom on Financial Insanity. We're going to be sharing some of the ways you can take better control of your financial future. And Scott, I must say, happy holidays, my friend. Always an exciting time of year.
Buddy.
Absolutely.
Everybody
buddy.
out there as well, we welcome you, and whether Hanukkah or Christmas or whatever you celebrate, we hope you're enjoying yourself. And if you're by yourself, grab a cup of eggnog and maybe spike it a little bit and enjoy this ride today.
Go.
We have fun together.
There you go. Good advice there, Scott. It'll help you enjoy the show even more, as we're going to be talking about this ARP study showing that we could be headed as a country into a retirement savings challenge. And no surprise to you, Scott, when you see some of these numbers that are brought up in this article, it's things that you know to be true.
The article is pretty amazing, where it talked about, 20% of adults at least 50 years had no retirement savings. And I think that's really important because obviously you're raising kids. I get it. And now you have to have you got to really slam on the accelerator and start saving a lot of money. I also noticed, I don't know if you read this report, not only 20% of 50 years old have no plan, and 57 million of the private sector don't really have a traditional pension, so we don't know what they're going to get. And so people are leaning on Social Security, which is a challenge. But I also noticed another stat that really was amazing to me. 25% of Americans have zero. 25%. So when you're going out with people, one of four have zero savings. And 50% are fearing, will they run out of money during retirement? So again, I look at those stats on top of the average Social Security is $1,800 a month. Can you live on that? Well, I guess if you move in with your mom and dad. So these are some key areas. And people are living a lot longer, as you know, out there. So if you haven't started, you can get started. If you need help, maybe you have a plan at work and you haven't started the plan, hey, give our studios a call. I say that out of kindness because you might want to use the current company's plan, especially if they're putting money in for you. I call it free money. And the question is, will that be a benefit to you? Well, yes, it will. The question is, if you haven't been saving much, well, maybe you need to start. If you've been saving much, but maybe you need to save more, you need to start. Maybe you're thinking about getting going and maybe you're begging your kids to start doing it. Who's going to take care of you? What's going to happen? Where do you get the money from? Again, these are areas of solution. We're living a lot longer. The lack of savings discipline is gone. The market volatility is, we have a new regime coming in. So these are areas we like to talk to you about if you're in there. And I can tell you guys out there, don't put this off if you have. And maybe you need to crank up some more. And those that are heading in retirement, that's a whole different story. I'd love to talk to you more about that later. But again, let's get some savings going.
Yeah, absolutely, Scott. As we're talking about this AARP study, showing what we know to be true is that we're facing a retirement savings crisis. It's just more difficult than before, and then also showing the folks that do not have retirement savings at all at this point. Now, Scott, how do you talk, because like you said, plan is just so important when it comes to your retirement, but how do you talk to people about those things that are hard to plan for, the unknowns, higher taxes, the economy possibly going down in the middle of a person's retirement? How do we, plan or at least instill some things to protect us from these, things that we know will happen, we just don't know when?
Yeah, the inevitable pops out, like the drones in New Jersey flying all over our head. If you've been around, you guys see it. Yeah, I'm out here in Fort Dix area where all the military base, and you got them all over the place. It's been amazing. here in New Jersey. But one thing I noticed, Alex, is an unknown force is retirement. Well, you know when you're going to retire, or you think you know when you're going to retire. Frankly, I'm lying to you out there because I don't know when I'm going to retire. I love what I do. I don't see myself retiring. But if those of you heading into retirement and you're ready to go into the go-go years, you're ready to go have some fun, you need to plan that budget. We've said so many different shows. We talk about the budget. How's it going to work out? We have a 2-family income. Now we're going into a no income, but we're going to have income from your dividends and interest from the investments you have, from maybe your pension if you have a pension, or maybe your 401k. You have a lot of money saved in 403b. How do you put all those areas together in a nice game plan? So if the market and the economy does have a big turn down, if there is a big challenge ahead that we don't see, it's called the black swan event, something we don't even pay attention to. How are you set up for that? And there's some tools in the world that could be like a CD link, CD, certificate of deposit, linked to the stock market with no risk unless you ruin the risk, because it's a contractual period between 3, 5, or 7 years normally. If you hold it to the end, you can't lose your money. It's guaranteed by the FDIC. What kind of gains could you have? You could have some really good gains. Or if the market continually drops, maybe you have very, very small gains. But again, there are tools out there, whether they're government protected, FDIC protected, insurance protected. And how can you grow your money? Well, that's where a plan starts. Everyone is not a cookie cutter. Alex, I've seen so many different people, and I do know the commonality. They want to make sure they're not going to run out of money. I do know the commonality. Do they have enough? So enough for you listening to me right now in your car as you're driving. It may be enough for you, but maybe the guy or gal sitting next to you, or maybe your friends, maybe they need more than what you're bringing in. Everybody's so different because of their lifestyle. And this is where you should practice that, Alex. This is so important.
Absolutely. Talking about this new study from AARP showing that we're headed for a retirement savings challenge in the U.S. Scott McLean talking with us about it, founder of McLean Advisory Group right here in Waretown. That number, as always, if you have questions, 609-488-4646, 609-488-4646. And Scott, retirement, it just looks different now. People used to have that pension. That's just Social Security, income along with it. You got to throw in those personal savings now, and that seems to be that third leg of the stool that is really the onus is on us more, it seems like, moving forward. Talk a little bit just about how retirement does look different today.
Cash is king. Credit is queen. Interest rates were 0 just a few years ago, 2 or 3%. Can't make much money. But if you're out there, what other tools were in the tool shed? We saw interest rates scream to the top. We saw people buying these 9% interest-sensitive treasuries. We see a lot of different tools in the tool shed, but that doesn't set up what I call it the dreams. What are your dreams? Which leads to the dollars you're investing, or maybe you need to invest more. Maybe you're investing too much. Maybe you need to invest in tax-frees, or maybe like Roth type of accounts if you're eligible. Maybe you should do Roth conversions if you're now fixing to retire in the next 1-2 years. Maybe those of you are retiring in the next 6 months. This is a great time to practice. What do you need on a monthly basis? Live on that. Don't live on the high on the hog. Because I can tell you, a couple came in, and when I met this couple, I can tell you Mario is just a beautiful gentleman, and his wife, Luis. And in speaking to them, what I found is they knew what they wanted to retire on a monthly basis. But when I asked them, let's take all of the cash, all the Social Security, your pension income, your 401k, how much do you have coming in? And they thought they were going to be just fine until I let them run the numbers. For Alex, is kind of unique and fun because I want people to run the numbers themselves. Can they live on, in this case, $7,000 a month and not have to work? Well, we look at the Social Security. We look at that 401k and all the money they've saved, which would be like a third leg. And then, of course, the pensions. We look at all the areas. And after I told them to run the numbers themselves, they said, wow, I guess we need to save some more money. Yeah, you do.
Yeah.
But I'd rather have them listen and figure it out themselves. And again, I give them the math to walk really slow through it so they really understand this could be a problem because everybody wants to retire early. Heck, everybody wants ice cream and cake and candies and without all the cavities and cholesterol. But the question is in retirement, this is not a do-over because you may have to go back to work, and that's not what the goal was.
No, absolutely not. And so we're talking about, avoiding this retirement savings challenge. What are some options for folks as far as creating income in retirement? Since this is going to be something, to think about. How do I recreate that paycheck, if you will?
Well, we spoke on a couple different shows, Alex, we did together. And the most exciting thing is there are some tools in the toolbox that are made and designed by way of contract to pay a dividend, whether they're a bond that pays twice a year, a corporate bond. Maybe they're a preferred stocks that pay 4 times a year, and we look at how strong the companies are before we buy them. Then we're looking at another vehicle called a real estate investment trust, some different types of REITs out there. And then we look at the master limited partnerships, the MLP. And those have been amazing tools, as well as the last one, Business Development Corporation. Businesses borrow money on a short-term basis. They pay a nice interest rate, and they pay beautiful dividends. This is one area. Then you got to go into the world when most people don't want to talk about, I don't want to talk about annuities. Well, wait a minute, time out. There's some really great tools out there in the annuity world called the fixed or the indexed that could give you a guaranteed income for life if you set it up properly. And the insurance company, Alex, the insurance company takes the risk,
right,
not you. So when you put your head on your pillow, the stock market's dropping, you wake up the next morning knowing that check's going to be in the mailbox every month on the first of the month. So you've had that planned almost like your Social Security. And again, Social Security is changing, guys. Unless they make a different change in the new administration coming down in 2025, we've got to fix the Social Security because that's going to be reduced in 2032, 33. So that's a game plan that I guarantee Congress will have to be looking at for sure.
That is the voice of Scott McLean at McLean Advisory Group. We really appreciate you listening each week to Financial Insanity. And I want to remind you that the number for Scott and his team, if you do have questions, is 609-488-4646. That is 609-488-4646. Just add a .com for the website for Scott McLean and the team at McLean Advisory Group, serving Waretown and beyond. And we have plenty more coming your way. Don't go anywhere. This is Financial Insanity, out-of-the-box thinking for your financial sanity.
Hey, this is Scott McLean. I want to wish you guys a tremendous, wonderful holiday. Merry Christmas, Happy Hanukkah, and all the lovely greetings we have for you. Proud to be in your life as we try to give you the financial information so you don't go insane. Happy holidays.
Stop for a moment and think about this. Do you know how much money in your 401k or IRA is actually yours? Or will the government take a bigger chunk than you thought? Remember, you still might owe taxes on that money, but do you have a plan to help make sure you don't pay more than you should? At McLean Advisory Group, we believe you deserve to keep more of what you've earned, which is why we're here to help you navigate the confusing world of retirement taxes. It's your money. You deserve to know what's at stake. Right now, taxes are historically low, but they won't be this low forever. So call the McLean Advisory Group team today so you don't miss out on this opportunity. 609-488-4646. That's 609-488-4646. You work hard for your money, and we'll work just as hard to help you keep it. McLean Advisory Group, 609-488-4646. Investment advisory services offered through Sound Income Strategies, LLC, an SEC-registered investment advisory firm. McLean Tax Advisory Group and Sound Income Strategies are not associated entities.
I'm on the fence about a real tree. I've done the real tree. When you have that fake one that's in 3 different pieces, you just bust it out every year and you take a second and it's already got the lights attached to plug it in and boom.
You like the smell. I do like the smell of those Christmas trees.
Yeah, but you can get that smell, in different ways. But anyways.
This is Financial Insanity with Scott McLean, presented by McLean Advisory Group.
Today we are discussing the income toolbox, all about building a stronger portfolio one tool at a time. I'm Alex Dingman alongside Scott McLean of McLean Advisory Group. And I know you're going to have questions. Jot this number down, 609-488-4646, 609-488-4646. Scott knows better than anybody that it takes a lot of different financial tools in your portfolio to keep your retirement on track. We're going to talk today about corporate bonds and the difference later on between corporate bonds and mutual fund bonds as well, because that's an important distinction. But Scott, let's, if you would, kind of display the power here of bonds and why we're talking about this here today.
I'm so excited about talking about bonds because I think about Jack, a classic growth investor. They want to grow your money. And he rode the waves of the stock market up and down for decades, enjoying the high and the enduring lows. But, as Jack, or maybe you out there, you get closer to retirement, you start losing a little sleep. Or maybe you got that spouse of yours putting an elbow in your side thinking, every time the market takes a dip, honey, you change your personality, or perhaps maybe you lay awake at night hoping and wondering by osmosis, will the market go back up? And of course, you learned the market's up and down, and you could possibly seeing your gains turn into losses. So again, we'll use Jack. He wants to start selling his stocks because why? He needs income. Write this down: reverse dollar cost averaging. You see, when the market's down, you're faced to sell when you have this income you want, and you have to sell at lower prices, which means you're selling more shares to get the same income, reverse dollar cost averaging. You see, one day, particular volatility, if the market's really swinging up and down, not only is your personality changing, I've noticed so many times, Alex, I'm sure you've seen the seniors, their personality changes. The market's up, you're happy, market's down. I say go to the doctor and get some Prozac, but pretty much you're on your way to keeping your money safe. We need income, tools that will pay a consistent income, whether the market's up and down. It's almost like a loan. So corporate bonds, as we talk about, it could be great. Now, imagine this: instead of stressing out about the markets up and down, you can pretty much get yourself a nice tool. You don't have to worry about the markets. You're out to dinner. You're playing with the kids. You're watching the football, the grandkids playing. And like clockwork, the check shows up in the mailbox or in your checking account, just as promised. So this could be a great tool. But those in the stock market, in the growth area, you don't understand how it works because you really haven't been in that world. And when you change from the growth world to the income world, it's a different world to understand. And it's almost like going deep sea diving. Are you used to it? Can you handle it? Can you sleep well at night? This is income, predictable. You can bank on it. And of course, this is what I find so important, Alex. People don't understand how to look at it in this time of possibly a great time for corporate bonds.
Right. Well, then that's what I was going to say. It seems like it could, take some of the stress out of investing, especially people as they're approaching that retirement, maybe want more of a quote unquote sure thing. But talk to me a little bit more. Okay, what exactly then are corporate bonds? How does this work?
Think of, Alex, your name is IBM. And you want to raise some money for some reason, so you're going to issue a bond. And you're promising to pay me, Scott McLean, or the investors online listening to us right now, in writing, a documented piece of paper called the bond with the stated date when it's due. Maybe you're going to have a stated interest rate. Let's just say it's 5%. And you must pay that no matter what, hell or high water. And you're banking it almost like it's like a loan. And so you're going to pay me twice a year as a corporate bond. So we know two things. Number one, we know the interest rates and we know when it's coming due. Now, what coming due, Alex, means really clearly, coming due means I got to give all the money back. So, Alex, if you loan me $100,000, or I'm saying I give you $100,000, Alex, for your bond, and you're paying me 5%, and the bond is called in 5 years. That means you've got to pay me a semi-annual payment 2 times a year, and at the end or the call period, when it's over, you've got to give me all my money back. So I'm just eating the interest. I call it the chicken and the egg. The chicken is the investment. The egg is the dividend or interest payment, and I'm getting that egg so I can either eat the eggs or I can reinvest the eggs and buy more chickens. And this is what's a lost strategy in the world of investing for fixed income. And don't misunderstand this for mutual funds. We'll talk about that later. Mutual fund bonds, but understand corporate bonds could be a wonderful place, Alex.
Well, and Scott, for folks out there that
Want to learn more?
609-488-4646. Again, 609-488-4646. I'd love to hear from you.
No, thank you so much. And, one saying my mom told me as a kid was, if it sounds too good to be true, it probably is. And Scott, I know you're a straight shooter. Let's talk about the corporate bonds. We talked about maybe some of the safety there, but break down the good, the bad, maybe the ugly about corporate bonds, if you could.
Beautiness of the corporate bonds is, number one, we have to see who the company is. Let's take a look at the company and rip it apart, and let's see if they can pay the interest payment. Let's see if they have too much debt. Maybe we don't want to go in a corporate bond. Let's rip off the facade of how beautiful the company is, like General Motors. When General Motors was a big company and people bought their bond, well, remember, General Motors became bankrupt, but they got 18 cents on a dollar. They didn't get the full money back. So be careful when you're investing for corporate bonds. That's the ugly. The good, let's say it's a very strong company. My friend out there, Public Storage or IBM or some strong companies. Well, we know that they can pay. They've got a strong balance sheet. We know that they're issuing a bond because they want to expand their business or whatnot. We're going to look at these corporate bonds and the safety of the corporate bonds. That doesn't mean they're guaranteed. It means, well, if they have enough income, if they have enough profits, they have enough assets, they could be a wonderful tool. Unlike a company called Xerox that used to be around. Of course, I think about other companies out there that could be maybe weak. Let's make sure they're strong. The good, I'm getting a check. I can bank on the check. The wonderful, I'm going to get a corporate, and after the period of time when the period is over, called the call date, or when it's ended, I'm going to get a check, like the Tiger Bond. The Tiger Bond in many years ago, which was the Treasury, was paying, 13.25% guaranteed. And you know what? What a great bond that was, guaranteed by the government. So let's take a look. Again, that's the government bond, but the corporate bond, let's look at the company. The good, the steady check. The bad, if it's weak and you buy it and you get caught in hype. The ugly, they go bankrupt like General Motors did, and you get pennies on the dollar. So this is important when you're looking at fixed income, that the advisors who really don't specialize in this area, almost like a knee surgery specialty or brain surgery, you've got to really dive into the nitty gritty before you buy this corporate bond. But the good news, oh my goodness, we don't want default. That's the ugly. But the good news, the steady check. You can bank on it showing up in your mailbox twice a year.
Well, and Scott, I love your energy for helping folks and for educating people, and the knowledge that you have here about different income tools as we're discussing corporate bonds today. But I can just feel it coming out of you that you're it's something that you just feel like it's really important, because it's something that you think that people are not educated enough about, right?
They're not. And unfortunately, I'm the old person in the house talking to you young people out there. What do I mean by old? You see, in 1982 to 2000, the market was nothing. Well, there's a couple dark skies, but it was blue skies. Anything you touched, anything you felt, anything you smelled, anything you invested in, it made money. So who the heck wanted to buy a smelly, yucky bond? Bonds are boring, Scott. I'm getting a steady payment. Yet the market's making a 5, 7, 10, 15% rate of returns.
Right.
And you are bored with this boring bond. And now a 2000 kicks in. The price to earnings ratio is 44-1. It was too high. It was a major industry. As we spoke about in the market, it's time to get out. Let's get out. Well, people didn't want to go to bonds. They were looking for the blue skies that turned into dark skies, and the market dropped from 2000 to 2002, and the market dropped. That's right. It dropped around 48%. Some Mutual funds and stocks dropped even 55%. But if you want that steady income, this, when you get older, could be a nice steady income, a great tool. I didn't say sell everything you have out there. Listen, make it very clear. I'm saying you need to understand, because people were not being educated on duration. They were not interested in, they were not understanding guarantees or what the companies were guaranteeing by way of paper. And they were not understanding how can I get paid. And therefore that was put aside, hoping and praying that the market would continue to go up. And when it dropped from 2000 to 2002, from 2007 to 2009, people were nervous. They couldn't sleep, Alex. Bonds could be a great tool out of all the tools in the fixed income area. And this is one of the wonderful type of tools if you'd like to sleep well at night and get that check in the pocketbook.
Want to learn more?
609-488-4646. Please write it down, 609-488-4646. I'd love to take your questions. I've got answers. And if I don't have answers, I promise you I'll get them.
That is Scott McLean, McLean Advisory Group. Remember the website as well, financialinsanityradio.com, as we're talking today about some different tools that you need to have in your income toolbox. We're discussing corporate bonds, but on the other side, an important distinction needs to be made. We're going to be talking about corporate bonds versus bond mutual funds. This is Financial Insanity, out-of-the-box thinking for your financial sanity. This is Alex Dingman of Financial Insanity with Scott McLean, wishing you a happy holidays. I hope you have good health and get everything on your wish list. Thanks for listening.
Stop for a moment and think about this. Do you know how much money in your 401k or IRA is actually yours? Or will the government take a bigger chunk than you thought? Remember, you still might owe taxes on that money. But do you have a plan to help make sure you don't pay more than you should? At McLean Advisory Group, we believe you deserve to keep more of what you've earned, which is why we're here to help you navigate the confusing world of retirement taxes. It's your money. You deserve to know what's at stake. Right now, taxes are historically low, but they won't be this low forever. So call the McLean Advisory Group team today so you don't miss out on this opportunity. 609-488-4646. That's 609-488-4646. You work hard for your money, and we'll work just as hard to help you keep it. McLean Advisory Group, 609-488-4646. Investment advisory services offered through Sound Income Strategies, LLC, an SEC-registered investment advisory firm. McLean Tax Advisory Group and Sound Income Strategies are not associated entities.
By the way, I'm an old dog. I'm almost 65, but I will accept presents.
Scott, are you just going to plug your birthday every show until the first of the year? Is that what's going to happen?
I'm going to plug it till I get a present.
Discussing the income toolbox today, building a stronger portfolio, one tool at a time. I'm Alex Dingman alongside Scott McLean of McLean Advisory Group right here in Waretown, serving Ocean County and beyond, helping you shore up your retirement future. That number, if you have questions, 609-488-4646 for Scott McLean and the team at McLean Advisory Group. As yes, we are talking about some different tools to help you generate some retirement income, discussing corporate bonds today. Very important topic, and we need to make an important distinction here, Scott. If you could talk about the critical difference as we are discussing corporate bonds, but also what a lot of people know about, maybe are invested in our bond mutual funds. What's the difference here? What do people need to know?
Let's get to basics. First of all, if you're out there and most people don't know about bonds and how they work, or maybe you have a little ideas, a bond is like a loan from a corporation. A bond is like a loan from a corporation with a set period of time called duration. So let's say it's IBM. They're going to offer a 5% bond, and it's for a 15-year period. So we know how long they have to pay that payment. Now, that's called a corporate bond. Again, we have all sorts of corporate bonds, from the risky to, of course, real conservative ones. That's called the quality of the bond. Now, let's jump over into the world of mutual funds. This is where it gets tricky. And a mutual fund bond is made up of 200 to 300 different companies in one portfolio. So you could have one bond mutual fund with 200 to 300 companies in that portfolio. Now, if you were to say, Scott, I want to have safety and security, well, my question to you out there, listen carefully. Let's say I've got a mutual fund bond portfolio that's paying a 5% dividend. And let's say I have 10 different corporate bonds, 10 different ones, that's averaging 5%. On one hand, you're going to say, I'd love to have the diversification of 200 companies versus 10 companies. But wait, did you understand who's offering better guarantees? Let's break it down. In a corporate bond, we know how the corporation's going to pay you and how much. So each individual bond, by way of, they write it out on the bond, they have a promise. But in a mutual fund, the mutual fund manager has, again, 200 companies, well diversified, right? But wait a minute. If the market is dropping and people get scared, you're going to be caught in a mutual fund portfolio as the market is dropping. But if you're holding individual bonds, you can choose to, I'm not dropping anything. I like that steady 5%. I'd like to have that guarantee of the company paying me a twice a year, that payment. And I know I'm going to get that payment for a certain period of time. So I've got certainty and guarantees by the corporation. Now, I'm not guaranteeing the corporation is going to go out. I'm saying, let's take a look. So as an investor portfolio manager of these portfolio of 200, I'm not going to talk to you, my clients out there. I'm just going to buy and sell what I need to. So when people are redeeming money, I may be selling some very good bonds just to make up the yield. But you out there, individual, you can keep these bonds. Now, let's make it, you know what? That's really deep, Alex.
Yeah.
Do you want some certainty? Individual bonds have more stability than mutual fund bonds. How about make that real simple? Why? Because we don't know when the market's dropping and you want to sell, you know what? Or you don't want to sell, but you want to enjoy that 5%. They may have to liquidate, and this loss could be a permanent loss in a mutual fund portfolio. It's just a stock of a bunch of bonds. And this is where people don't have that predictability, that accountability. They don't know what's inside of it. But when we have individual bonds, we can look at them, we can analyze them, whether we should get out or not get out. And this is a big difference when we talk about the difference between mutual funds, bonds, portfolio, and individual bond, corporate bonds.
Want to learn more?
609-488-4646. If you're stuck in the weeds, give me a call off the air, 609-488-4646. That's our studios. If we can help you, let's help you, because bonds are tremendously exciting now as interest rates are starting to go down.
No, I love it, Scott. And really, it's all about that level of risk. You know, how much risk you want to take? How much do you want to be into the stock market? And I think that conversation, too, it is a different one as you get closer to retirement, right? So maybe discuss that a little bit. As, you know, you're getting closer to retirement, maybe, depending on who you are, maybe that's the security that you're looking for.
I really don't want people to get thinking that all bonds are safe.
Right.
So I'm very nervous what I just said a little while ago, because they're based on, number one, how long you got to keep them, called duration. But on top of that, you could buy what's called high yield bonds. Now, people get excited about high yield bonds because they think, oh, I'm going to make a lot of money. Woohoo! Wait a minute. High yield bonds are the riskiest, because there are companies who have the portfolios don't look too good. Maybe they need some right guard because they're starting to smell. Maybe they need to raise money, high yield bonds. And so lately they've been absolutely just catapulting, doing wonderful, because it's hard to borrow money. But when interest rates start to drop, do you want some guarantees? Do you want to sleep well at night? Let's find a tool in the toolbox called corporate bonds, whether they're risky ones or not that risky ones. Let's understand your risk level, because everybody wants cake and ice cream, but nobody wants the calories, the extra fat. So be careful on how much risk you want, because there's several types of bonds out there people really don't understand, and they could get stuck in the muck. That's why they give us a call, and when we talk to our clients about where they want to invest their money, we call it the dreams. I want the money to come in. I want to be able to take trips. I want to go on trips and not worry about the market. Then we talk about the dollars, where to invest the money, and the tools that'll give you those dreams to come true. And then if we pass money on to the children, called the dynasty, how does it pass on? Did the kids usually cash everything in at once or not? And this is the definition of really a 3D planning in your portfolios. And bonds could be a good mix as rates go down. As we just saw previously, the rates were skyrocketing. Bonds took a real, they became a anvil around your neck. They were dropping like a time bomb. Now it's inverse. It could be a wonderful tool out there. So again, understanding your tools is critical, Alex. If you don't understand, call us.
Well, and there is no one size fits all, and that's one thing that your team gets really excited about, is somebody coming in and it's a blank canvas and you're just looking at it and saying, hey, fill me with all the knowledge so I know who you are, what you're trying to do, and then you're going to use your knowledge and your team to try to craft a plan that's going to set that person up for the most success they can have.
We have tremendous variety of people, not only for the colors of the people, the good looking or the ugly ones like me, but we have people who are married, and they're married and they start their retirement journey at age 60, some 55, some 65, some older. Maybe they have younger spouses. Maybe the one spouse is 75 and the other spouse is 60. Wow, is that a diverse journey? How do we make the money last longer? What tools should we use so the money lasts a good long time for the younger spouse? And that doesn't mean that the younger spouse is going to live out the older spouse. In addition to the ride, in the early years, it's called the go-go. You want to go, see things, enjoy life. Like my best friend, his wife is about 12 years younger than he is. And they said, Scott, my wife, I'm going to have her retire right now. He is 65 right now, and his lovely wife is younger, and they want to start doing things. Well, you know what? Their planning is going to be different than if they were both 65. Or maybe they have a certain amount of income they need to last a good long time. Or maybe they're older. Let's say another couple out there that could be both 75. Do we want to pass money on? Where do we put it in? How much do we need to pull out? How do we pass the money on so the money lasts a good long time for them? Should we put the money into an irrevocable trust to hide the money from the nursing homes? Should we put the money in a different type of account to have some more growth? I don't know. And Alex, you made a good point. We have such a diverse amount of people out there. This is exciting. What makes me excited about my field, I mean, if I can last another 20 years in this field, I just love this because everybody's so different. It's not the same old, but everybody has the go-go years, going into the slow-go years, going into the no-go years. And so things change, Alex, and I think about this. What are you out there? If you're looking at retirement, how are you looking at retirement? What are you doing? How are you setting your retirement up? Are you talking about this on an annual basis with your advisor or on a semi-annual basis? And then are you looking at tax ramifications? And then how do I preserve the assets for the next generation? Hey, if you want, give me a call at our studios. You may have questions right now. 609-488-4646. Let me say it again real slowly because I don't want you to miss out, to understand how mutual fund bonds, corporate bonds, and other type of investments out there could really be beneficial at this time. 609-488-4646. And by the way, that's our website, 609-488-4646.com.
More to come here on Financial Insanity.
Who likes uncertainty? Wall Street certainly does not. With near record inflation and partisan politics, there's a lot of uncertainty right now. What will America's future look like? What will your future look like? Will your taxes go up? Will your savings go down? For more than 40 years here in the Jersey Shore area, Scott McLean and the team at McLean Advisory Group have seen uncertainty come and go. No matter what the future holds, Scott can help you create a plan designed to preserve your finances in uncertain times. And it's not a matter of if those uncertain times will show up, but when. Call 609-488-4646 now to meet with Scott McLean and the team at McLean Advisory Group. If uncertainty is causing you to feel insecure, Scott McLean might be able to help. Call 609-488-4646 and schedule your visit today. Again, that's 609-488-4646.
Investment advisory services are offered through Sound Income Strategies, LLC. Investing involves risk, including the potential loss of principal.
Frankly, you could have your grandkids tweet out to your friends or go on the Facebook or Instagram or whatever it is and say, I got great information from Scott.
And you left out TikTok there as you're rambling off the different social media being used by the kids today. You got to remember that TikTok.
That's right. Tickety-tock.
This is Financial Insanity with Scott McLean, powered by McLean Advisory Group.
Well, there are certain things that you are not supposed to bring up at a dinner party. And there are a few topics that you're just too uncomfortable. You don't want to talk about with even your kids, your spouse, let alone a financial professional. But there are some important topics that we need to think about, especially as we get close to retirement. So we're going to talk about those today. Bite the bullet, dig into the top 5 list for this week, the top 5 taboo topics in retirement. I'm Alex Dingman, host of Financial Insanity. I'm here with Scott McLean of McLean Advisory Group, the founder of McLean Advisory Group. And Scott, this is part of your job. You know that you're going to be talking about things with folks that are difficult to talk about. And I want to get started on this top 5 list, Scott. So the first thing, number 5, as we're going to count down, is death. I mean, it's not something we want to talk about, not a fun conversation, but it's a part of retirement, and it's the kind of thing, but it affects your plan when it's part of the discussion, obviously.
It does, and you kind of want to speak when we meet with the clients about this. What happens if your spouse dies? What happens if you die? Let's run the numbers on both sides. Again, paying attention to the real numbers of saying, can you survive if your partner, spouse passed away and you're depending on the income? Then what's the game plan? So kind of a game plan of what if scenario. I could say the worst case scenario. Daddy always said, Scott, always figure out the worst case scenario, then go for it. And I think that's important. So again, death is inevitable unless we're raptured out of here, which should be a fun ride. But I can tell you, if that doesn't happen, dying. Most people don't want to talk about death. They don't want to talk about finalize. Well, that's a spiritual thing that I feel strongly about. And then for not only spiritual, emotional, what do the kids know, or the beneficiaries, the spouse, do they know your desires, and they know your dreams, and they know what you want, and they can change. This is important. This is number 5, the death list. The death list is, I don't want to think about it, talk about it. Dad, I don't want to talk about your money. Son, we're going to talk about it. That's how our conversation started, because that dad was very direct. And I think I want those of you out there being very direct with your family. What do you want? What do you see? I think the next one, Alex, kind of ties in with death. I think I'm sure you know the next. What's the next one we're talking about?
Yeah, so mental health.
That ties right into death, because I mean, if your lights are starting to twinkle, some of you out there, maybe your husband, your wife, your dad, your mom, the lights are twinkling and you're saying, oh my goodness, what's the next game plan? How do I set up the estate? Do I have the power of attorney for financial matters? Do I have the power of attorney for healthcare matters? This number 4 on top of death is the biggest concern is, what if my mom and dad start to lose it? What if I start to lose it? Do I have some signs? Are you paying attention? Because this is an emotional, tremendous struggle. And then do we need to move around money in the portfolio? So again, this discussion, you can't put it off.
Right.
So we have to have a what-if scenario.
Absolutely. And when it comes to mental health, too, part of that conversation also is just helping people not be overly stressed. That's powerful. There's a lot of things, to think about in retirement, but that financial worry, you don't want to just have that during retirement. That's really holding you back. So that's the kind of thing where, Scott, having a plan in place can help with your mental health in retirement for sure.
And it could change. I mean, some people have long-term care. You're seeing the prices go up. Do you keep them? Do you not keep them? What do you do? Let's take a look at the estate. Should you put your house into a trust? What kind of trust? These are really discussions that you really need to have with your financial advisor. And when you speak to him or her, or you want to give our studios a call, you want to have a conversation with me, I'd love to do it off the air, whether you work with me or not. 609-488-4646. I'd love to share a few minutes with you, and if I can help you and guide you, and perhaps this is a place for you or not. That's not the reason you're calling. You're calling to say, can you help me on these taboo discussions? We're talking about death, divorce, possibly mental health, or divorce. You're right. I think that's another topic, isn't it, Alex?
Yeah, let's go to that one. It's another taboo topic, but it must be discussed. As we know, over the past 30 years, divorce rate after age 50 has doubled in the U.S. What about some financial challenges for a couple divorcing as they get close to retirement?
This is a real challenge, Alex, when you're living with your mate, your spouse, partner, and the wheels start to fall off and you start to see things differently. You're not the same person you used to be. And that leads to what are we going to do? We're going to live in the house and cohabitate and spend and split our bills. Well, that gives you indigestion. I can tell you, going home and seeing the person you don't want to see. I hate to talk about this subject, divorce. Divorce is painful. And if you're going through it now, I understand what you're saying. I've been there, and it's no fun. But I do understand there's light at the end of the tunnel once you get it set up. But this money crisis, this dividing of assets, this money, how do I make sure my monies won't outlive? Now I'm living on a one income versus two income. This is a real challenge for those. Maybe you're seeing it coming on your life. You need to have those discussions with your financial advisor, even though you may not feel comfortable. You know what? Uncomfortable is okay, but you got to deal with it so you become comfortable. So again, divorce is you don't even want to think about it. But I guarantee you, Alex, you said 50%. That means you're going out to dinner with 4 couples. Somebody's thinking about something. I hope it's not you.
Well, and the other side of that too, Scott, is that you're prepared and you're happy to help somebody too with, well, this divorce happened and now my plan is totally different. You know, we had this plan forever.
Yes.
And now that the divorce has happened, it's going to affect things, and you'd be happy, hey, you come on in, let's look at your plan now as a more independent person and what that looks like, but you're happy to have that conversation as well.
And we've had it, Alex, with our clients. We've had clients we've just loved to death. I will not, George will not, our firm will not pick sides.
Right.
We need to get you through this and help you understand. So if you're out there thinking I'm divorced, what I love doing is, who is your backup? Is it your son, your daughter, a significant other? Maybe it's your close friend of yours that you might want to lean on as we discuss these very important topics.
Yep.
So you can make sure that your life will continue to go on and not really worry or as much as you have to or that you're going to. Well, you might worry. The question is, what are you going to worry about? Let's take care of the money. Let's see if the money's going to keep coming in. How do we change your portfolio for you?
Mm-hmm. All right, so we're going through the 5 most taboo topics in retirement. We've talked about death, mental health, divorce. Another one, we just have 2 left, is relationships. So retirement, it's going to have an impact on the relationship with your spouse, your kids, grandkids. How important it is for pre-retirees to start thinking about some boundaries, you know, when it comes to watching the grandkids, just how much time they're going to be spending with their spouse when they're both home all day. Things like this, definitely you have to plan for.
We spoke about that once before. I'll never forget when Dad said to me, "Son, I'm going to take a job." I said, "Why, Dad? You don't need the money." "I just want to get away from your mother and do something." All right, Dad, I get it. I didn't understand back then, but you know what? People need to get away. They need to have that break. But doesn't mean you don't love the person. And this is a discussion I have when people say, "I want to move." Let's say North Carolina, South Carolina, I want to go to Florida. Well, let me ask you something. What's the budget you put away to visit the grandkids? Again, another problem you brought up, Alex, is when the children happen to come to the well all the time and ask for money. This is a taboo discussion because you don't want to talk, well, I'll always help my kids. Well, you can always help your kids to the point where you can burn so much money up. And now here you are and you're 76, 77, and now you're completely out, or you're not living the lifestyle, and you're very healthy. Hopefully we're all healthy, but you don't have the money because you were keep giving and giving, a tree that keeps giving. And now we have a stump left. Terrible, terrible way to think. And this is where you have to say, no, I can't. No. And this is a cuss word for many people, especially if you're a Labrador out there and you love everybody, you love your kids, you can never say no. Well, this could be a real damaging effect in the big picture.
Finally, the number one thing on our list of taboo topics, and this one's a little ironic given the fact that, well, we talk about this all the time, but money. That can be a taboo topic in itself. Talk a little bit about how some people, they just have a hard time talking about their finances.
Sometimes people think that they have a lot of money and they should be fine, and their neighbor next to them maybe doesn't have that much money. How does that conversation work? Now, it's not about money. It's about relationship. The question really is, you don't want to talk about money. This is where you really need to get in a relationship with your partner, your spouse, as well as the advisor, if you use an advisor, because this is really personal. And not talking about something could be a problem. You need to bring up some issues. For example, in my case, mom and dad, dad did the bills, and then mom didn't see what was going on. And then dad says, Joan, I want you to do the bills. I want you to see what's going on. So we find out where the money is going, how is it going out, and how are we handling our finances. I'll never forget dad doing with mom and they getting it together. Did mom like it? No, daddy paid the bills. But I think he was getting her ready just in case something happened, and dad did pass away before my mom. And so you need to have these discussions with your loved ones on top of the discussions with the kids. And again, this is a taboo. No one wants to talk about death. Your kids don't want to hear it. But you know what? Put your foot down, husbands, wives, dads, moms, and say, hey, here's what's going on. Let's make a quick conversation. We don't need to belabor it. Again, where does the money? Again, money means different things to different people. To you, maybe money's freedom. To me, maybe money is just, can I get my next meal? So how we look at money, how we pay attention to it. I don't know if this answers the question, but again, this topic is so amazing. You go to a church sometimes, and I remember one person said, Scott, money's not everything. You're right, it's not everything, but right up there with breathing, it's pretty close to it because you need to have it. And so I'm thinking, is your money in a place? Are you sharing? That doesn't mean to talk to people, everybody, about your money. It's like somebody going to Atlantic City and winning the gambling table or pulling the slot. And of course, you won that day. But what about the last 2 years, 3 years? You haven't won. You talk about the winners, you don't talk about the losers. Well, this is important to talk about money. This is really important. And for those of you, maybe you're embarrassed to talk to your kids. Maybe you need a little help. Maybe you say, kids, I need to downsize. Let's talk about it. These conversations are so hard. And it's rather do it now than all of a sudden your mom and dad's lights are starting to twinkle and they start to forget, and they forget more. And now they're saying, okay, what's going on? And they forgot. You're having that same conversation for the third time in the next 20 minutes. So you're seeing that maybe things are starting to change. Do we have money? What do we do? And this is the conversations we have with our clients so often, to making sure that you're in the right position, or maybe we need to change positions, or we need to get set up to maybe open up some different type of trust planning, or to protect your assets. This is important. 609-488-4646. I want to put a tool out there, you guys. It's a wonderful tool. It's 609-488-46. It's called the telephone. The phone will bring you right to myself or George. We'll be able to answer some of your questions because, you have a tool. It's out there. You want to use it. No cost, no obligation. Let's have a quick conversation. Discuss what's on your heart. Again, we just brought up 5 areas, Alex. Would you go over those 5 areas, Alex? This is what you need to talk about. It seems to be taboo, and you cannot avoid the uncomfortable conversations. Alex, what were they?
Absolutely, yes. Scott and his team, happy to have these conversations with you, make them a little easier. Death, mental health, divorce, the relationships you have with your spouse, your kids, your grandkids, and then also money. Those are the big 5. And a great conversation today, Scott. Thank you so much for all of that wisdom. And we appreciate all of our great listeners. And until next time, thanks for listening to Financial Insanity.
Hey, this is Scott McLean. I want to wish you guys a tremendous, wonderful holiday. Merry Christmas, Happy Hanukkah, and all the lovely greetings we have for you. Proud to be in your life as we try to give you the financial information so you don't go insane. Happy holidays.
This radio program may contain information which has gone regulatory or other significant changes since its original recording. The information and views expressed on today's show is educational in nature and is not intended to be a recommendation for any specific investment, product, strategy, plan, tax, or legal advice. Information presented is believed to be factual and up to date, but we do not guarantee its accuracy. Investment advisory services offered through Sound Income Strategies, LLC, a SEC-registered investment advisory firm. McLean Advisory Group and Sound Income Strategies, LLC, are not associated entities.
This radio show is a paid placement.